Be Wealthy and Smart, episode 1064.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about Google's stock split. Is it time to buy? Well, on Friday, Google's stock after the close split 20 for 1. And that means starting today, you don't need to spend $2,000 a share to buy Alphabet, symbol GOOGL. That's the parent of the Google search engine. This was a one-time special stock dividend, and the idea is to draw in a wider audience because shares are more affordable. So investors who held shares or who were shareholders of record at the market close on July 1st were issued an additional 19 shares for each share you already owned in a one-time share dividend. The 20-for-1 stock split reduced the price A class of shares to roughly $111 today, based on Friday's trading price of $2,228.80. This is Google's second split in its history. Now, it's a little confusing because Google has several different types of shares and two different stock tickers. So the split applied to all shares of Google, the Class A shares, GOOGL, the Class B shares, which are privately held, and the Class C shares, which are symbol GOOG. Class B and Class C shares have no voting rights with the company, and Class B shares aren't publicly traded. Now, since the company first went public in 2004, there's been only one other stock split, and that was way back in 2014. This latest plan for the split was unveiled by Google at the same time they released their fourth quarter revenue report for 2021, which exceeded expectations. As far as what Google has indicated for its second quarter results, it's already told us it's going to be impacted by the Russian war with Ukraine, a worsening macro environment, and tougher comparisons against pandemic highs and changing foreign exchange rates. Foreign exchange is tough for multinational companies because of the strength of the dollar. That means if you're operating overseas and are getting revenues overseas, whether it's Google or Starbucks or any international conglomerate, they are going to have to convert those foreign dollars back into US dollars. And because of the strength of the dollar, that means they're getting less US dollars. And that means their profits are cut by the exchange rate. When you have a weaker dollar, that's when the exchange is working in your favor and it helps to boost your profits from overseas. But that's not what's happening right now. We have had a strengthening dollar, which is kind of wreaking havoc with emerging market countries that denominate their debt in dollars. It's very difficult for them to have the dollar getting stronger. Their debt is getting bigger. But it looks like the dollar may be topping out here somewhere around 108. When the dollar's strong like this, it's a great time to travel internationally because your dollar goes farther and makes the price of foreign goods cheaper. So this is a really good time to make that trip to Italy and buy those beautiful Italian goods and save yourself some money. In terms of what the investment community thinks of Google as an investment, according to a survey of 52 analysts, 50 have an outperform rating on the stock with a 12-month consensus price target that implies about 38% upside. Now, as we look at the broader markets, I think things are looking like we're getting a bounce here. A very strong rally is something I've been predicting for a while, and it looks like that June 17th low is holding. We went down, tested the low, the June 17th low held, we went up, we came down again, tested the first test of the low, that held again. So it looks like that June 17th low is staying strong. and the market feels very oversold and like it wants to go higher. Again, I'm seeing over 1,000 points and beyond for NASDAQ, a massive bounce coming this summer. So beyond Google, we've been following some other stocks that also had splits. We were following Amazon, which already split, and we were following Tesla. Tesla is still in the works. It's a proposed 3-for-1 split, and shareholders will vote on it at the company's annual meeting August 4th. So we hope they pass that, and we can look forward to a split of Tesla stock. So again, we don't just buy companies because they split. Please do your homework and your research on the outlook for the companies, what their earnings are looking like, and how they're doing. But I think Amazon, Google, and Tesla are 3 that are strong growers that really got oversold in this tech sell-off. And their market multiples came down so dramatically, they looked like a really good buy and something that was offered to us at a much lower price than they had recently been. So do your own research, but today we have a much lower price for Google. If that's something that you want to invest in now, that's something you certainly can do. At this price, it's much more affordable for any new shareholder. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available so you never miss one of them. And all my podcasts, many more than are available on Apple Podcast, are on my website at lindapjones.com/podcast, where you have my entire wealth mentoring library at your fingertips. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.